What do you make of the Fed minutes? What we heard, a very hawkish Fed. The majority of Fed members actually advocating for 2 more hikes this year, and cuts pretty much off the table.
Yeah, no, I mean, I think the market was kind of surprised to see that there wasn't that unanimity that we thought there was. But I also think the market's not really surprised. We have already priced in the expectation for 2 more rate hikes this year at about every other meeting going forward. So I think that's not the surprising point. I think the Fed thinking about a potential recession, a mild recession at the end of the year is obviously concerning. And then their concern about China, especially after the economic data that we got this morning, is also concerned. I think putting pressure on markets this morning for sure.
All right, Lizzie, I think you said concern about 4 or 5 times there. So with that in mind, what is your WEX word of the day?
Well, so my word of the day is actually calm for the trading day ahead. I know we're down pre-market, like I just said, but this is a week that is a holiday shortened week. Volumes are low. People are really waiting for the jobs number tomorrow. We got through the Fed minutes yesterday, so I think that I think today could be a calm trading day as we're in a wait and see mode for tomorrow.
All right, so if today's calm, where would you put money to work at today? We were mentioning the transports just broke their winning streak, and again, futures are under pressure this morning.
Yeah, no, today's a great day to put money to work if the market remains under pressure, at least through the mid-morning. One area that I'm going to go the opposite direction, Frank. One area that I'm kind of avoiding at this point in time is the financial services sector. It's a sector that's been, it's underperformed year to date, down 1% versus the up 16% of the S&P 500. And a lot of that has been due to the mini banking crisis that we went through earlier this year. But my concern with this sector is less about that, more about how they're going to make money going forward. Because the reality, Frank, is that we're in an operating environment where the yield curve is still inverted, and deeply so. The Fed's not done raising rates. And the expectation is that rates are going to remain higher for longer, which doesn't bode well for credit quality. You're already starting to see loan losses increase. You're seeing reserves being taken, albeit at all reasonable levels at this point in time. But earnings for this sector have been unreliable for 5 quarters in a row. We're expecting a couple more quarters of earnings declines. And I think with the overhang of the commercial real estate potential crisis, I think it's just hard to get excited about this group right now.
So financials are where you're staying away from. We've been talking about the possibility of more rate hikes. How do you feel about tech? We've seen a bit of a pullback. Is this a time to maybe buy into that pullback?
I do think there's still opportunity within the tech space. Of course, the valuations have gotten quite lofty, but I think that's partially because earnings haven't kept up with the expectation for AI. And I don't think it's just tech that's going to benefit from AI. I think overall, the market in general has the benefit of productivity gains to look forward to when it comes to AI. And there's this major uncertainty related to it and the new technologies that are coming about how it's actually going to impact profitability and numbers, because we don't know how quickly it's going to be adopted, and we don't know what the magnitude of that's going to look like. So I think there's a lot of opportunity here. There's some of it has been priced in, but there is more opportunity.
Thank you very much.